Hello everyone and welcome to This Week in the Markets. There was some exciting news last week that helped to push the markets to new high. Specifically, we'll be discussing the ECB's plan to purchase government bonds, China's approval of its $157 billion project, the non-farm payroll report, and what this all means for the markets. And we'll do that right after our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So after more than a month of psyching the market up for something big, Mario Draghi finally delivered the ECB's bond purchase program last Thursday. The outright monetary transactions, as they called it, will focus on purchasing 1 to 3 years government bonds in the secondary market to help bring down bond yields of nations that are finding it difficult to fund themselves. The purchases will be unlimited in the sense that ECB will do whatever is needed to keep bond yields below a certain cap. But at the same time, Mario Draghi said the purchases will be sterilized, which means that they will balance the balance sheet, most likely through auctioning 1-week deposits to banks like they did for the securities market program. However, these operations do not completely sterilize the bond trade purchases as the name suggests, so we still expect it to have an inflationary impact on the market in the long run. That could make gold in euro terms attractive from a long-term perspective. In China, the government stepped on the pedal to stimulate the economy as it approved more than $150 billion worth of infrastructure projects last week. Not only would this help to boost the Chinese economy, it also raises demand for industrial commodities such as steel and copper. Consequently, base metals had a huge surge last week, but steel prices are near the bottom of its range in the past couple of years. If the government continues on with more of this kind of stimulus, we might see a stronger rally in base metals, and that could help give emerging markets equities a much needed boost as well. At least for now, that seems to be a likely scenario, as the Chinese premier reassured on Monday that the government has more room for fiscal and monetary measures to support the economy, and also to meet this year's target growth of 7.5%. The non-farm payroll report on Friday suggested that the US probably added around 96,000 jobs last month. This is quite a bit worse than expected, as analysts were forecasting jobs growth to be around 130,000 in August. To add to the bearishness, July's non-farm payroll was revised downwards by 22,000 to 141,000, so that is in total more than 50,000 jobs less than expected over the 2 months period. The only number that appeared mildly positive on Friday was the unemployment rate, which dropped unexpectedly to 8.1%. The figures in the non-farm payroll and the one used to calculate the employment rate is conducted by 2 different surveys, so it is possible sometimes that the unemployment rate could indicate a more bullish picture than the non-farm payroll might suggest. However, this is not the case this time, as the primary reason for the drop in unemployment rate was due to a sharp decline in the number of people actively looking for jobs in August. Perhaps this is due to the summer vacation as well, but all in all, this is quite a bearish jobs report. However, equities continued to rally on Friday on what's been coined the Bernanke effect. What this means is that the weaker than expected jobs report gave rise to expectations that the Fed will announce another round of quantitative easing later tonight, after their 2 days meeting which began yesterday. According to a survey conducted by the Wall Street Journal, 72% of economists responded say they expect the Fed to announce large-scale quantitative easing this month. As we said last week, we do not expect any large-scale quantitative easing when jobs are still around the 100,000 mark, because while it is a weak number, it is not one that requires emergency actions from the Fed. There are talks that the Fed might engage in an open-ended quantitative easing, which means that they could start with a small amount such as 50 billion and continue to revise the figure every month as needed. We think that this would be a more plausible scenario because the Fed wants to demonstrate its support for the market, but at the same time it might not want to commit to such a large-scale purchases given that the economy is not that weak and there are signs of recovery, albeit slowly. But is this enough to satisfy the market's expectations? Well, we'll have to wait and see. But we think that given the degree of the rally and equities trading at a new high, if the Fed only meets expectation, it could cause a temporary pullback and we could see a small correction or consolidation next week as traders start to take profit off the table. In the coming weeks, on top of the Fed announcement tonight, we'll also see a number of important indicators such as the CPI, the retail sales, the building permits, and home sales, to name just a few. This data could sway the market one way or another. With also trading volumes back to normal now that summer vacation is over, we could have a very volatile week ahead of us. And also within the trading this week could possibly set the momentum for the short-term trend as well. So we'll have to be watching out for this data and see where it leads us. And that's all from us this week. We'll have another update for you next week. Until then, on behalf of the Trading Pursuits team, we wish you all profitable trading.